Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, December 5th, 2022. It's 12:38 p.m. Eastern Time. So I'm starting the video, and I'll do a brief update on the big things that I typically watch, the major asset classes, stocks, bonds, gold, and commodities, and it'll just be an overview. I pardon my lack of posts this morning. I had a doctor's appointment, and that took longer than usual, just a biannual derm check, but I had to wait for an hour, and then had some errands I had to knock off today. So I'm just getting back to my desk, catching up now, and I just wanted to kind of recap everything. No change in my outlook. Last week, told you, I've kind of shifted from a mostly neutral, unsure bias in the market where things are going towards shifting towards a downward, expecting a downward bias heading into the Fed. Previously I'd said you tend to chop around the month of December, and I still think that'll to a good extent hold true. So like I said, downward bias. Last week we had that nice shorting up, one of the by far I think the most objective shorting up for swing and trend traders I've seen in several weeks at least, and that was a rally right into the primary downtrend lines. There's the S&P 500 via SPY. These are our primary bear market downtrend lines from the start of the bear market back here in the beginning of the year, and that's that. And so far good for like I said, I laid it out as one of two things. Either long-term swing or trend trader can begin to scale in there, start taking positions. We may certainly pop those. We'll probably know in the next couple weeks here once the Fed's out of the way. But remember, we still, even when the Fed's out of the way, you have the low volume end of year, around Christmas time, New Year's. You also have year-end position squaring, window dressing, tax loss selling, and a whole bunch of stuff that just may make typical swing trading a little more difficult, whether you're bullish or bearish. But that's it. All we can do, like I say, to just keep it simple, all you can do is wait for your setups, wait for the most objective opportunities, long or short, and that's what that was. So far, nice pullback there. We're pinched between a rock and a hard place on the S&P 500, or really between resistance, which is that primary downtrend line. I just zoomed in here on another board, and the uptrend line off the October lows right there. So you can see that one is just as valid. Here, let me go back to that other board that's a little more clean. There's that primary downtrend line right there that I started out with, and here's the uptrend line off the October lows right there, and that's where we're at. So we're between support and resistance. Most likely, no guarantees, but most likely get a reaction on the next tag of that level. But a break of that level, I'll set an alert if I don't already have one, would also be bearish. So that's what the S&P 500 looks like. And again, well, I didn't say this yet, but right before, the days leading up to the Fed meeting, which is on the announcement, I believe is the 14th. Is that next week, next Wednesday. Any breakouts or breakdowns that occur right in front of that have a much higher rate of failure. So I try to either avoid breakouts that occur right before a big market moving FOMC meeting like that, or take them with a big grain of salt. But anyways, those are levels to watch. And of course, there's the 200-day moving averages I mentioned. We tend to cap rallies, even if you go over for a week or so. That's common, and that's that. So. Oh, the other thing is you have the PPO crossover is pending. See, it's getting really close. We've had two times where it came down low, but we never had a cross, including recently there. But much more downside, especially a solid break below that trend line, that's going to trigger that, and that's going to be a pretty powerful sell signal. So that is still my preferred scenario. I still maintain that we are in a bear market with another leg down to come, and I still maintain this is the most likely bounce target. We already came about 2/3 of the way up into that, if you can see that there on the chart, the red box. And then that purple box is my less likely, but still, certainly, well within the realms of probability for a bear market rally, and that would be up there. But I think, like I said, I'd much rather, and am, shorting here. I'd rather continue to add to those shorts on the way down, or any consolidation or up to that level, but I don't want to miss a reversal because I think there's a decent chance that last week's high right there on Friday, nope, on Thursday, may have been the end of this bear market rally and the start of the next leg down. Okay, so that's what SPY looks like, and again, we'll watch for those bearish PPO crossovers. QQQ, same thing. Got a little more room before the bearish, before we get a bearish PPO crossover. But on QQQ, I had that alternate. I had two trend lines right here, and starting off the highs in the beginning of the year, which was just slightly higher than that previous high, but that's where the S&P topped, and that's the trend line, the first trend line that comes in. So you have one, two, little brief overshoot, but enough and there's a clean reaction there. And then there's that upper trend line. And again, this would be, if if the market rallies post-Fed, that would be an excellent shorting op area to add to shorts or initiate new shorts if you're not short yet, or if you're long to close out those longs because you have the 200-day moving averages and this secondary or alternative downtrend line off the highs right there. Okay, so that's that. IWM, same thing. You had a golden, nice, very objective shorting op last week as highlighted. And, so far it's good for about a 3% pullback. Nothing big, but, an active trader could take quick profits, or a trend or swing trader can continue to scale in. There's a uptrend line to watch as well. Obviously bearish if that's broken. And then let's not forget, I updated the VIX recently. They all tie in together. This is the daily chart. There's your primary downtrend line. So this line right here should come in roughly with a pullback or test or break of the uptrend line I just showed you on SPY. I'm going to get back to that in 1 second. So this is, again, it would be perfect if there was no big Fed meeting this month, or it'd be even better if after the Fed meeting, we get a clean breakout, we consolidate around, pull back. I think I'll get to the short-term charts. I think we're good for today on the downside. I just covered the shorts I came into the day with. I'm going to game a quick bounce right now. I'll show you those short-term charts in a second. But again, so that downtrend line on the VIX, it's nice and clean, and that one should come into play if and when that trend line, the uptrend line on the SPY goes. So that's what I'm looking at, some of the main things here. All right, let me give you short-term stuff. NQ, NASDAQ 100 futures. You can look at I'll show you a 3-month chart right here. Remember, we're coming off this divergent high, which is one reason to have for the last week or so, a short bias there. There's a nice clean up trend line, which would be an objective level to either go long or cover shorts if you're short at the time we get there. And there's also a downtrend line right there, a back test of that trend line, which we already had one right there. We're back testing it now again, or almost. Let me pull it here a little closer, and let me zoom in a little tighter so you can see better in the video. There it is. So we're close enough right now. So yeah, I think we'll get some buying here soon today, right now, about from the point I'm doing the video. And I'm trying to extend that line. It's hard. I zoomed in so tight. Right here, you have a near-term downtrend line. That's my bounce target. I think we come up here today, boom, do that. And let me show you what it looks like on the shorter term. Here's a 10-minute chart right there. So this is what I saw, this 11,832.75 level-ish. I covered that one last week. That's a support level. It's not a super solid support level, but it's a line I've had on this chart for a while, and I think we can get a little bounce there. And when you look at the QQQ 5-minute chart, that's also played into this. We have some positive divergence, and I'll show you that real quick. So this is very short-term stuff. Watch, rinse, repeat. This is your active trading time frame, and again, I think there's benefit to active trading in the month of December when things tend to grind around. You had a divergent high right here. See your divergence down below. Then you had a trend line breakdown, back test, and you had that nice trend to trade. And then that set up this downtrend line you should have been watching or could have been watching. There was your breakout right there. Boom. Told you to buy. Then you had this first negative divergence or divergent high was right there. And from there, we've actually stair-stepped down. boom, boom. We zigzag down, boom, boom. This is a downtrend, lower lows and lower highs. And we're coming up on not great but decent support. And again, I'm kind of in that active trading mode, and I think you get that these mean reversion trades. And what I mean by that is, look, we've had over the last few days, that was I think Thursday's high right there. We dropped 2.5% on QQQ, and today alone, there's Friday's close. We're down 1.5%. And so what tends to happen when you get these big rips like this, big rip right here, they get faded. This is the fade so far, all of this. But even shorter term, you go up, you have a sharp down like that, followed by a sharp up, then a sharp down, big gap down, and then a nice up, another leg down, and then probably a leg up. And so support and positive divergence. You know me, I like to see that on the 5 or 10 minute charts. And so that's what we have right now. So maybe a little bit lower, but I didn't want to miss the turn. If we go down to 287.60, I have certainly plenty of room to add. And then there's also a little minor trend line that probably get things going if we take that out right there off the recent highs. And again, that's a little 5-minute chart. So. Okay, gold and silver. I told you recently I expect some downside. I'm still remain longer term bullish, just near term bearish for the reasons I stated last week. Euro into resistance, negative divergences. This is a daily chart of gold. Bigger picture says, or at least tells me, when this level right here, 158, was recovered, this whole thing was a nice bear trap. Very bullish, the fact we regained 158. But it's been a heck of a run to do so from there to there. That gold rallied about 11%. Silver was almost double that. If you zoom in tight, I'll go to a different board, but I'll show it to you right here. You have this negative divergence. See these small negative divergences? Let me find a clean board and I'll draw it out for you here. Right there. So you have prices making a higher high right there, indicators making lower highs, i.e. negative divergence, and probably get a little more downside, I think, leading into the Fed. And we are at support now. The thing about it is I'm not looking for a moonshot trade to the downside, just a little more downside. This is the first support, 164.85, excuse me, and then 161.31. That's even better support, and I'd like to see gold get back there and recycle back into some swing positions. That's GLD, the ETF, and if you trade, pulled up, let me pull a chart of GC here for you. Gold futures right there. Nope, I might have to. These may have rolled. A lot of things have been rolling. A lot of my futures have rolled recently to the next contract. GC February. Yep. Okay. Yeah, that's what. Let me look at another monitor. Yeah, that's what I'm short. I'm short the February GCs and short the January silvers. So right now the February contracts of gold. That's the continuous contract, has more volume. That's the one you want to be in. There's a 60-minute chart that we 60-minute divergent high, I should say, we headed into to today, and then boom, those divergences are now playing out. And it's not just gold, it's also silver as well. That is the December. That's not the one I'm in. That was the old one I had marked up, but you can see the divergence there. Where's my January? Let me look down here. Bear with me, I've got a lot of charts going, and I will find that one for you in just a second here, or I will pause the video, which I need to do because I can't find. Oh, there it is. All right, so on this charting platform, they haven't rolled that to the continuous yet, although it is the one with the most volume right now. And so again, that's the January. So that's why you get these choppy candles. As soon as they mark the January contract as a continuous, it'll show, but you can still see where it's been trading, and you can still see, most importantly, the negative divergence. That's what I love. This is my swing trading time frame. And so again, as of last week, I said, time to maybe book some profits on those gold and silver trades. And if we can get down here, actually there's one more support level I need to give you right here that may come into play, and we'll see how the charts look at the time. Right about there, 21,735 right there. And then for you that or those of you that trade ETFs, this is SLV. This is the daily chart, and there's that same. You also, just like gold, you have negative divergence right there, right? And so it's been a nice run off the lows right here. And just back in the beginning of September, we've rallied 32% in silver, so nothing wrong. Probably needs a little breather. And there's a downtrend line I think it'll still come to and ultimately break above. It's just a matter of what do we do first. All right, and that's what I think. And of course, as you guys know, and if you're new to the site, just go back and check the, there's all these, you can access all the videos and the other charts and trade ideas chronologically. Just scroll back. This one I've been harping on a lot, and it plays heavy into my analysis on gold and silver. That's the euro US dollar pair, or you can look at the dollar chart. I do as well sometimes, or just the euro, but that's it. We rallied right into that downtrend line, which was a target all the way back here from this divergent low. We broke out of here, so we've been zigzagging higher. This was the catalyst for that 32% rally in silver and 20 or whatever it was in gold. It was the rising euro and falling dollar, and because now the dollar and the euro US dollar pair has hit resistance, that means euro down, dollar up. Is the most likely thing. And again, Fed meeting coming up, so we may grind around. Also negative divergence. So like I said, it doesn't get any better. I can make a pretty darn good near-term bearish case for the dollar right now. I'm sorry, for the euro, which is bullish for the dollar, and bearish for gold and silver based on this rally into resistance right there, followed by a nice rejection today off the trend line there. And of course, not to mention as well, the top of my long-term major support resistance zone right here, you can see in the euro US dollar pair. So just a whole bunch of, confluence of resistance. And even if it wants to punch up a little more, the weekly chart, I have the downtrend line slightly higher. So yeah, I'm going to sit tight for now. Still favoring some downside there on the metals. And likewise, after being long and bullish Treasuries for quite a while, think there's pullback coming, so I'm short those. This is TLT. There's a weekly chart. Downtrend line, nice rally into resistance. You can look at the daily chart of TLT, the 30-year bond ETF. There was a breakout. That was our buy signal there. Getting a little stretched. I don't have solid. Yeah, actually, this is pretty good resistance here, about almost 108. Decent, not great, but again, it has a lot. I put a lot of weighting on where the yields are. And this is the 30-year bond yield, and again, a little more downside to the first. This is at comparable support on the yield to the resistance level I just gave you on the bond. Let me make that line a little brighter. And so we're getting pretty darn close there. And remember, traders are also going to put a lot of focus on the 10-year, sometimes even more than the 30-year. Very important bond, and that one is at nice support right there at the support zone. There's a trend line right there. If broken, that should be near-term bullish, but we're coming off this divergent high right here. This trend line break, that was a sell signal, and yields have been moving lower, which was the catalyst for the rally in bonds. Remember, yields go down, bonds go up, and vice versa. So now watch for a break of this trend line here, and or a reversal off this level, and that'll probably give us a near-term boost in yields, which is a near-term pullback in bond prices, and that's what I suspect will happen leading up to the Fed meeting. And just an update on crypto. Crypto's still dead to me as long as it's below this level right here. This is Bitcoin, and Bitcoin's still the big one. Ethereum's going to follow it. 18,079, that's on Bitcoin, the actual crypto there. Futures are going to show you a similar level there. Again, this chart goes back 6 months, but that was a major support shelf. It was broken and back tested here, and we're still below it. And looking at this, there's a little minor uptrend line there. You can even draw a little bit of negative divergence. That might give us a small wedge that could play out for another leg down. Again, it would take a solid recovery back above 18,080 to really start to make a case to get long crypto again at this point in time, in my opinion. Okay, last but not least, I'm just going to rifle through the sectors of the S&P 500 because that's what I'm also looking for, watching closely for any sell signals. What you have down here on the bottom, I'm going to park the RSI. We don't need that right now for this, and I've covered this quite a bit recently. I'm watching watching for bearish PPO crossovers. First of all, let's look at the markets. There's the S&P 500, like I covered earlier, very close. That is when this green histogram goes red. That means when that happens, that means the lines have crossed. That was the last. Again, I've covered this many times. There was our last bearish PPO crossover. We had one there, we had one here, and we had one here. And that's when the bear market started. So you can see, do you want to be long or short on a bearish PPO crossover on the S&P 500 in a bear market? So that's what I'm watching for. We haven't had it yet. And then I think I covered that in the beginning of the video I did on the majors. QQQ close but not there yet. But you can see the lines, kind of flattening out here, rolling over. IWM small caps. That one already crossed. Had one little whipsaw on Friday, but still it's crossed back negative again and looking pretty precarious right now after rejection off the downtrend line. I think I covered that earlier. If I didn't, I already did last week. The same thing with S&P 500 and NASDAQ 100. The rejection off the primary downtrend line, some divergence there as well, and flirting with that uptrend line right there, and a bearish PPO crossover, which is already in effect. And now you have 11 sectors in the S&P 500, so I can go through these quickly. All you have to look at here is the PPO, and it tells you, because it's just a whole lot easier, than trying to look and see when these lines cross. There it is. So no cross yet, but pending, and I think we're going to get it. And this gives me that, helps formulate my intermediate term and even near-term bearish bias. XLV, one of the stronger sectors, but either way, not at risk right now of crossing, but we'll certainly want to watch here. And let me just go back to that. I just noticed something other than the breakout above this trading range, which is just, it's happened so many times since the bear market started. This has just been a large topping pattern. And one thing I wanted to add, when I was looking at this, I can see a nice clean uptrend line you can add right here as well. So you want to watch that break of that and a move back into the trading range. What happens is once you break out of a trading range like this, it's the move back down in there that almost always sends you back to the bottom of the range. So that's what we'd be looking at most likely in XLV, second largest component of the S&P 500. XLF already gave us a big divergent high here, and it's solid. We got the PPO crossover all the way back here. What is that, on Monday of last week, so a week ago, and so far a lot of nice follow through. So I'm seeing more and more red. These are check boxes, not yet an XLC. That one's solidly in the green, but we'll watch it. XLY, give it credit, it's still hanging in there. But XLI, the industrials, solid. We had a crossover again on Monday, so it's been a week, nothing but red bars. So it's been moving lower, rejected off resistance, divergent high to boot. And XLP, close but no cigar, very close. I mean, just a little more downside. And again, it's not just this, it's that. And if it comes down here, it's going to break this primary uptrend line as well. And that's probably going to usher in more selling. So this is a daily chart. So these would be trend, swing trade and trend trade sell signals if we get those. So like I said, the more you get, the more likely it is that those are going to stick and not be whipsaws. XLE, I've been bearish on this one. Put on as a short back here. We had a breakdown there, and we back tested, and we made a marginal, ever so slightly higher high, but it was just a divergent high. It extended. We didn't have divergence on the trend line break, but then we did on that divergent high right there. It's been clearly moving lower, and as I said, back all the way back here, it has to break S1, support 1. That's the first support level. That's what that means, S1. So sometimes I'll list it if it's like a target, but not far enough down. I'll just call it S1 or first support. And look at that big red candle today. Crude's down pretty good. Natural gas is down. So this one, it's still one of my favorite shorts. And if you're frustrated, then swing and trend trading is not for you. Sometimes we get immediate gratification on our trades, and sometimes they take a while after a breakdown. before the move plays out. There was immediate gratification back there, and then sometimes you get stopped out and you're wrong. There are no guarantees, but it's just do it mechanically. If this thing reverses up and starts to go up above, at this point in time, it really should not take out the previous high. That was a whipsaw. It was a false breakdown, aka false breakout. I mean, broke out above the previous high there. Yeah, just lots of reasons, in my opinion, to be short XLE, and one of those included is the fact everybody wanted to be long the energy stocks back here. I don't know about now, but that's one of the most overcrowded, overloved trades, and those are the ones I like to short. XLU close, but no cigar yet on the crossover. XLRE, the REITs, very, very close. There's your uptrend line. This is a beautiful bearish rising wedge right here on the REIT sector, XLRE, again, one of the sectors in the S&P 500, poised to make a bearish crossover on any more downside, which obviously a break of the wedge should do the trick, especially if it's impulsive. And last but not least is XLB. Basic materials, same thing, divergent high. I'll put the RSI back on. You can see the negative divergence, and that one already gave us a bearish crossover. So there it is. You've got a good percentage. I don't know, close to half of the sectors in the S&P already rolling over on the giving us bearish crossovers. We can get a few more, and most importantly, I put even a higher weighting on trend line breaks and things like that. So those are the things to look for, and if you get them, I'd prefer they come after the Fed next Wednesday. So my guess is we grind around for the next week, as I've been saying, and you play those mean reversion trades, and one of those, like I just gave you, is QQQ, pop this trend line, run up here. I'll have to, well, I didn't have targets for QQQ. I think I gave you some for NQ. I think we can come up at least right there at about 290. That'd be a pop of almost 0.75%, a little less than that, and maybe certainly, well, not maybe certainly. I think that's an oxymoron, but quite likely up here at about 292 or so there. All right, I'm going to wrap the video up here, get it out to you. And if I see anything else, the only other thing I was looking at that might take off, I just started nibbling today after I got back, was lumber futures. That's LB. 1 second here. Where is my LB? There it is. So you have, this is a 60-minute chart right here, and you can see this right here gives us a divergent low. It actually comes all the way back. If you look at that line here, you can see that better. When you see big divergence like that on a 60-minute chart, and there's the lines, then you want to go out to a longer time frame, and then you can see it a little bit better. And so that's what it looks like here on the and so what happened is, what I like about it, and the reason I took a starter position, it's been in just a downtrend. It just can't catch a bit. This is a downtrend, stair stepping lower. But see this low? That was our previous low. We undercut it. If I draw a straight line or just put a horizontal line there, not by much, but if we can build on the gains right now, see, we undercut it right here, and if we can get back up, then that'll be a false breakdown, aka bear trap. And the reason I think it'll be the case is, again, you have that positive divergence that's been building right there. So anywho, just one idea to throw out to you. I'm gonna wait. I just took a starter position, just a small position, and I'll add if I start to see it move on up and firm up that whipsaw signal. Otherwise, if it takes out much below today's lows, I'm gonna let it go. All right, I'm gonna end it here. Get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.